Welcome back. You're watching Your World at 10. Apologies for the really long commercial break. We were connecting into our special guest tonight. And before I introduce him, here's a quick recap. Today's big newsmaker story of the day. Eurozone leaders finally struck a deal. The three-part package includes a 50% haircut for private lenders holding Greek debt. The European Rescue Fund's firepower has been increased to a 1 trillion euros. That's the leverage potential. And the third 106 billion euro recapitalization, for European banks. Well, joining me to discuss this historic package is Trevor Williams, Chief Economist of Lloyds T.S.B Corporate Markets. Trevor, thank you very much for joining me. I say historic, even though I understand that this package is what many analysts are calling it long on intent and short on details. Nonetheless, do you like what you've heard so far from that EU summit agreement?
Well, I think it's far superior to the other 13 meetings. This is the 14th one in the 21 months since the EU's Eurozone government said they'd stand behind Greece. So it is good news that at least they've managed to agree on these range of measures. But as you've said, they are long on rhetoric and intent, very short on the details, much more to be decided. And so the initial reaction, just to finish quickly my answer, is that markets do seem to like it very much, as you can see from their response with equities and bond yields, and of course the spreads narrowing somewhat.
All right, let me get to the first component of that deal, and that is the 50% voluntary haircut that seems to have been worked out between the private lenders holding Greece's sovereign debt and the Eurozone leaders that met in Brussels through the course of yesterday. It is voluntary, so it is no longer a credit, or it does not qualify as a credit event. But Trevor, I'm skeptical because the July agreement said a 20% haircut, and even that 20% haircut was not fully agreed upon. Not all private lenders subscribe to that one. So how?
Absolutely.
Yeah. So how realistic is this 50% haircut agreement?
Well, as you quite rightly said, the July one was 21%. This is 40%, 50% rather. It depends on the participation rate. That's the short answer. How many banks will actually participate in this haircut? And when we say voluntary, we must put some inverted quotation marks around that, because that was either you get 50% or you get nothing, I think was the way it was apparently presented. Now, of course, on the surface, this is a good deal for Greece, and the challenge then is for the banks to find the money to meet their end of the bargain, to make the shortfall from their own profits or from raising money themselves to meet the 50% haircut that they've now agreed. There are also issues around, well, what exactly triggers a CDS default then? If 50% doesn't do it, what does? Why are you buying credit insurance if when you buy it you don't seem to get any redress, even if you don't get half your money back?
I know that is the parallel dialogue that seems to be going on, because on one hand there's skepticism about what this 50% will eventually turn out to be, and on the other hand there's worry about what will this mean for the CDS market, because this is not voluntary if you have a gun to your head.
Absolutely, and I think that the challenge there now will be who would want to pay for insurance protections against credit default. In short, who would want to lend to sovereigns? And so if sovereigns have to raise money, surely it means it's going to be more expensive to raise it if lenders don't have some insurance against a default. I mean, I think that this risks unraveling one aspect of the market which has actually been working quite well in sending signals about the riskiness of various assets.
I guess I have to ask, though, to go back to the 50% haircut. They've also announced a recapitalization of European banks to the tune of 106 billion euros. Now, do you see this, the two going hand in hand, to the extent that the 50% haircut amounts to about 100 billion euros and the recap amounts to a little over 100 billion euros? Am I adding 2 and 2 and coming up with 22?
Yeah, well, no, I think that makes perfect sense to me. that the amount of the haircut is exactly the amount, roughly, which has to be recapitalized. And of course, what that means is, first of all, remember, let's look at some of the detail of the agreement. What it says is that in the first instance, banks have to go to private sources to raise that money, first of all. So if they take it from profits, that means there's less to lend. If they go off and borrow, then that also means there's less to lend, because they have to pay the money back and they won't have that money available to lend. I mean, I think that this potentially weakens economic recovery insofar as it's dependent on lending by banks. And on top of that, if you do have to go to the EFSF for money, then it's likely to be at a punitive rate, which means very few will want to go there for that money. So there are some big question marks about how this is going to work on the ground and in reality.
So in effect what they have done, Trevor, and I wonder if I can argue this, they've allowed for a default to take place, except they've called it a voluntary haircut because it is a 50% default. They decided to forgive Greece that default and bail out the banks that would suffer under that default. So it looks like a default, it smells like a default, except we're not calling it a default, and we're bailing out banks to ensure that it has no systemic impact.
Yes, but and just to say, of course, I absolutely agree with that. There's a nice saying in the market: if it walks like a donkey, brays like a donkey, well, it is a donkey. The problem, of course, is that the money still has to be found by someone. And if sovereigns have to find the money, then that means that it comes back to the balance sheets of the 17 governments that are in the euro that say that they will then insure 20% of that money which is loaned to the banks to meet any default, any recapitalization that they borrow from the markets. So it's an odd thing that after insisting on a 50% default, these 17 governments will now offer some insurance against any borrowing by banks that require money to recapitalize and who borrow from the private sector.
What kind of role do you see the EFSF, considering that now we've been told that the EFSF may be levered all the way up to €1 trillion? What kind of role do you see it playing in both trying to patch up the gaps that are opened up by a default, as well as ensuring that Italy and Spain and other peripherals get the support that they need, either through intervention in the bond market or any other direct means as well?
Yes, I think first of all it must be said that the ECB has been untethered from being involved in this, that whilst they will still buy bonds or in the secondary market of Eurozone countries, they won't directly participate in the EFSF, and that's a good thing in my view, because it means that the central bank of the Eurozone will be able to concentrate on its core job, which is to keep inflation low and stable. So I think that's a good thing. Insofar as, of course, they are holders of 169.5 billion of bonds, of course, that they have already bought. So we don't really want them necessarily to buy a whole lot more of these bonds. The EFSF, you're absolutely right. How will that actually work in covering off all of these things that you have said? How will it manage to be able to continue to support the medium-term credit worthiness of Spain and Italy? That partly depends on their response. They have to put in place, as the agreement says, credible plans to put their fiscal house in order. And moreover, the FSF is also supposed to be there for banks to borrow from in extremis. So I think it's a tall order, and if you look at the amount of bond buying which might have to be done to support all of these in the medium term, even €1 trillion isn't enough, and that's assuming that it can be levered up to the extent that's been said. I have doubts about that.
All right, that's a fair point. I have time for one more question with you, and Trevor, I'm going to move away from Europe to talk a little bit about the US third quarter GDP number that we saw today, 2.5% annualized rate. Well, I'm sure that's what economists were expecting, and it's not going to do much to the unemployment rate for sure, but it does put all fears of a recession on the back burner, doesn't it?
I think it does. I think that even the figures that are suggesting what may happen in Q4 don't look bad. I think actually that the figure for Q3 looks an underestimate, I have to say. So stock building, for example, didn't contribute as much as one would have thought. Auto sales, which we know have picked up, didn't contribute as much as one would have thought. And I suspect that the figure is likely to be revised higher. For Q4, I think that it may not be as strong as 2.5% or whatever the revised figure is, but I suspect a figure of 2% or so looks likely, which means that the likelihood of the US falling back into recession in Q4 has receded. I think it will still grow relatively weakly into next year, but at least it's good news that the effect of state retrenchment, state level fiscal retrenchment, doesn't appear to be affecting the figure as much as it was previously, and that the private sector does appear to be stepping up its spending, which is a reflection of improved balance sheets in the US. So yes, I suspect that this means that prospects of a recession in the US have certainly receded.
All right, Trevor Williams, we appreciate the time you've taken to join us with your commentary both on the EU deal as well as the US GDP number. That's Trevor Williams, the Chief Economist of Lloyds T.S.B Corporate Markets, joining us from London. It's turning out to be a rather good day for global markets. With that, I'm going to wrap up this edition of Your World at 10. Thanks for watching.